Good afternoon, friends. In the subject of the fundamental of investment, today I'll be talking about derivatives. Friends, if you recollect in our previous lectures on investments, we talked a lot about cash market. We talked about stock exchanges, how the price discovery takes place. And by and large, our focus was on the cash market, where the transaction is being settled by buying and selling of shares if I talk of the stock market. Today I'll be talking about derivative markets or derivatives. Before I talked about the derivative markets or the different concepts of the derivatives, let's understand what derivatives is all about. So what we will be discussing in this topic is what is the meaning and the features of derivatives, who are the participants in the derivative markets, what are the types of derivatives, financial derivatives, forward contract, future options, call options, put options. These are the different issues which we will be discussing in today's lecture and in the lectures to come on the subject of the derivatives. So let's start with the meaning of the derivatives, what we understand by the derivatives. See, derivatives is a financial instrument that does not have its own value, but rather its value depends on the value of some underlying asset. That underlying asset may be some physical asset, or it may be in terms of commodities, it may be in terms of real estate, it may be in terms of shares, it may be in terms of index. So it may be in terms of interest, exchange rate. For all these financial instruments, for all these different types of financial assets and the real assets, there are derivatives markets, and there are derivatives. And the very idea of the derivative is the price discovery, which I'll be talking later on. So derivatives does not have its own physical existence. A contract takes place on the basis of some underlying asset between the two parties, and on the basis of that contract, the derivatives is being derived. So means derivatives are the financial instruments that does not have its own value, but its value in turn depends on the value of other physical assets, which are known as underlying assets. As I said, underlying assets may be real estate, it may be commodities in form of gold, silver, copper, aluminum, oil, right? Or it may be, commodities in the form of farm commodities, agricultural commodities like pulses, like wheat, rice. Or it may be the financial assets like stocks, debentures, or you can call it bonds, or index itself. Like in India, we have two indexes in terms of, if I talk of the stock indexes like BSE and the NSE, so the Sensex or the Nifty. For all these different type of assets, there are derivatives market and there are derivatives. So derivative does not have its own physical existence, but emerges out of a contract between the two parties. This is very important, that derivative itself is not an asset. It is not a physical existence, but it is a contract between the two parties, and out of the contract of the two parties, the derivative is derived. So the value of the derivatives may depends on these underlying assets. If I talk of the gold derivatives, so the value of the derivative of the gold will depends on the present value of the gold in the market. That is the present price in the market. If I talk of the stock derivative, so the stock derivative, the value of the stock derivative will depends on what is the present value of, what is the present index, or what is the present value of that stock. If I talk of Reliance Industries Limited, what is the current price of the Reliance Industries Limited? Say it is 2,500 rupees. So if the price of the Reliance Industries in the stock market is 2,500 rupees, and if I want to make some derivative contract with some other party, right? So the value of the derivative will depends on the current price of the market. So the different types of derivatives that I can engage with the other party, I'll be talking later on. But the derivative price of Reliance will depends on the current price of the Reliance, that is, or if I say the price of the Reliance in the stock exchange. So the value of the derivatives may depends on any of these underlying assets. So these underlying assets may be shares, as I just said, debentures, tangible commodities in form of the gold, silver, copper, aluminum, or it may be agri commodities like pulses, rice, or it may be currencies, short term or long term. So term financial securities means long term and short term financial securities. So these are the different type of underlying assets of which the derivatives is being derived. So stock index futures and the stock index options are also called derivative products. And what are the underlying assets? I have already explained: stock, bonds, natural gas, crude oil, metal, foreign currencies, other financial instruments, right? Now, after talking of what we mean by derivatives, let me come to what are the characteristics of the derivatives. Friends, at this stage, you might not have understood what exactly derivative means. Once you will understand the features and we will be talking of the different type of derivatives, at that point of time it will be more clear in your mind that what derivative is all about and what we mean by derivatives, right? So let's discuss the characteristics of the derivatives. What I have talked so far, I am again summarizing it, that derivative itself does not have its physical existence. The derivative is like a contract between the two parties, and on the basis of some underlying assets, the derivatives contracts are being derived. It's a financial instrument. This itself becomes a financial instrument. It may be of financial assets like stock, like bonds, like index, right? Or it may be of the commodities, right? So various type of products that are there for which the derivatives is being derived. So let's discuss the characteristics of the derivatives. The transaction in the derivatives are settled by the offsetting or squaring transactions in the same derivatives. So the difference in the value of derivative is cash settles. As I said, derivative is like a contract. So when the contract takes place, so this contract will be offset by the contract itself. That is, supposing if in the derivative market I purchase rice, I purchase wheat at X price, and this agreement is for a period of 1 month. This contract is 1 month. As and when the expiry date will come, there may be difference in the price of the wheat at which I have made an agreement, right? So this, suppose I have purchased wheat at the rate of 35 rupees per kg, and 100 kg of wheat is being purchased, and the expiry period is 1 month in the future market, right? So at the time of the expiry of the contract, the wheat price becomes 40 rupees. So the 5 rupees difference takes place at the time of the expiry of the contract. So if the contract is for 100 kg of wheat and the rate of rupees 35, then I'll have to pay the difference of the two. That is, my purchase price is 35. At that time, the price is 40 rupees. So 5 rupees I have to pay per kg for 100 kg. 500 rupees I will have to pay to the buyer. Means I have made a contract to the other party. So this transaction, these derivatives are settled through the same derivatives, and the difference in the value of is being cash settled. Cash settled means in transaction the difference is being settled to the monetary means. There is no limit on the number of units transacted in the derivative market because there is no physical assets to be transacted. Friends, this is very important. We say one of the characteristics of the derivative market is that the price discovery takes place. When I use the word price discovery, how the derivatives helps in the price discovery? Suppose a company has issued 10 lakh shares. So in the cash market, at the most, 10 lakh shares can be bought and sold, because that is the maximum number that is there in the physical form. The 10 lakh shares are there. So on a particular day or maximally 10 lakh shares can be can be bought and sold, because that is the number of shares that is there in the physical existence. But in the derivative market, since no actual delivery of the shares takes place, it is only a contract, and the contract is being offset by the difference in the prices at the time of expiry. So, no physical existence is required. That's why on the basis of 10 lakh shares of the company, in the derivative market, any number of shares can be transacted. It may be 50 lakh, it may be 60 lakh, it may be 1 crore. I am not giving any number. Means the number of shares that can be dealt of that company in the derivative market may be more than 10 lakh, because it's a contract only. No physical delivery or physical buying and selling will take place. It is a contract, and it is being settled through the difference in the prices at the time of the expiry of the contract. That's why there is no limit as such on the number of units being transacted in the derivative market. And when there will be very large number of transactions, obviously it will help in better price discovery, because not only you are taking into account the current aspects, but you are also taking into account the future, that is in the future, because the expiry will be taking place on a future date, right? So there is no limit on the number of units transacted in the derivative market. The other important characteristics in the derivative market is the derivative markets are usually screen based, computerized exchanges as against the trading market for physical assets. See, when you go to the market to buy wheat, buy rice and all these things, means there is a physical market, and the market, the purchase and sale of these commodities of gold, agri commodities and these commodities takes place. But in the derivative market, they are being traded, they are being exchanged through the computerized exchanges, like for example, if I talk of the commodity market, like MCX and NCDEX, National Commodity Exchange of India, or MCX, right, Multi Commodity Exchange, right? Through MCX or NCDEX, the transactions takes place. So all these transactions are on computerized based. They are transacted on computers, right? Similarly, if you talk of the stocks, that is, stocks is being traded in the derivative market either on the BSE or the NSE, and that is being traded through the exchanges, which is again a screen based trading, right? If you are talking of the index derivatives, right, in the index derivative also, that is being traded through the stock exchanges, and that is all computerized, right? So the derivative markets are usually screen based on computerized exchanges as against the trading market for physical assets. Other characteristics: derivatives are only secondary market securities and it cannot help in raising funds to a firm. In fact, derivative arises only when the shares and debentures are already issued by the company. Friends, if you recollect, when we were talking about IPO market, initial public offer market, I said companies do issue shares in physical form. When I say physical forms, although these days the shares are not being issued in physical form, but in the depositories the shares are being deposited. But anyway, shares are being issued. So the fresh money can be raised from the primary market, from the investors, right? And a company want to issue 1 crore shares of rupees 10 each at a par value. So means the company can raise 10 crore rupees by issuing those shares to the public in the primary market. But derivatives are the contract of some underlying assets. Underlying assets means the assets which are already in existence. If I talk of the stock derivatives, it means the companies for which the derivatives of those companies which have already issued shares in the market, only for those companies the derivative contract can be formed. What it means is that fresh money cannot be raised through derivative market. It is only in the secondary market derivative transactions takes place. So derivatives are only secondary market transactions. And this market is quite liquid, right? In the sense, because the volume is very large, if I talk of the stock exchanges in India, if I talk of the BSE and the NSE, the transaction in the derivative market is many times larger than the transactions of the cash market. If you observe the data of the BSE and the NSE, that how much transaction, what is the turnover in the cash market and what is the transaction in the derivative market, you will find that transactions in terms of the volume, in terms of the value, right, is many times, the transactions of the derivative market is many times larger than the transaction of the cash market. That's why this market is quite liquid. Now, after talking of the characteristics of the derivatives, let me talk of the type of derivative markets, which I had hinted when I start talking of the meaning of the derivative. Commodity derivatives and financial derivatives, elementary derivatives and complex derivatives, exchange traded derivatives and over-the-counter derivatives. Let me tell you very briefly the meaning of each of these. Means these are the three broad categories of derivatives that are prevalent in India: commodity derivative, financial derivatives, elementary derivative, complex derivatives, exchange traded and over-the-counter derivatives. Let me talk each one of them very briefly. See, commodity derivatives are mainly for commodities, like it may be agri-commodities like wheat, rice, jute, metals, right? And it may be of the gold, silver, oil, copper. And the financial derivatives are of financial assets, assets like shares, debentures, currency, interest rate, index, right? These are all called financial derivatives. Means the derivatives of the commodities, real estate, right? Means we call it real asset. They are called commodity derivatives. Financial derivatives are of financial instruments, financial assets like shares, debentures, currency, interest rate, exchange rate. These are called financial derivatives. These commodity derivatives are traded on MCX and NCDEX. These financial derivatives are traded on BSE and NSE. Although there are in India, there are other state exchanges also, but by and large, when we talk of the stock exchanges in India, these are the two exchanges which comes in our mind, BSE and NSE, because the volume in other exchanges is almost negligible. That's why whenever it comes to be that which are the stock exchanges in India, mainly two names comes in our mind, NSE and BSE, right? So we say the financial derivatives are traded on BSE and NSE, and the commodity derivatives are traded on MCX and NCDEX. Commodity derivatives were developed before the financial derivatives. If you recollect, if you go to the history, you will find in India, since time immemorial, our farmers used to sell their product to the traders in advance at a particular price. What is this? If I talk of the wheat, rice, before the harvesting takes place, right? If a farmer is expecting that he will be getting 500 kg of wheat, in the 500 kg of wheat used to be sold to the trader in advance before the harvesting, right, at a particular price. So a contract takes place between the farmer and the trader, and that this much quantity of rice or wheat will be sold at this much price. So this is nothing but the commodity derivatives. So traditionally in India, in villages, in small towns, this commodity derivatives took place, right? Used to take place. So before the arrival of the financial derivatives, these commodity derivatives started. If I talk of India, these financial derivatives have already have started in the 80s only, in the decade of 80s, right? So financial derivatives are comparatively new derivatives as compared to the commodity derivatives. So this is basically the difference between the commodity derivatives and financial derivative. It means that commodity derivatives are mainly for commodities, right? Wheat, rice, commodities, and other commodities, gold, silver, and the financial derivative for the financial assets like shares, debenture, index, currency, and interest rate, exchange rate also. So these are called financial derivatives. Then comes elementary derivatives and complex derivatives. By and large, in our lectures on derivatives, I'll be focusing on elementary derivatives, right? So elementary derivatives which are easy to understand and simple. Such derivatives are like future and options, This futures, I'll be talking these things, concepts in very detailed form, right, in the next lecture probably. So this is called the simple derivatives. Complex derivatives are little bit difficult to understand. They are complex natures like synthetic futures, exotic options, right? These are called the complex derivatives. So in our lecture we will be focusing on elementary derivatives. Other type of derivatives is exchange traded derivatives and over the counter derivatives. Exchange traded derivatives means the derivatives which takes place through exchanges. When I talk of stock derivatives, when I talk of the index derivative, these derivatives takes place through exchanges. As I was saying, most of these derivatives are through screen-based trading. So these screen-based tradings takes place, like again my focus will be mainly on the stocks and the index, right? The stocks means shares. So if I talk of the financial assets, the shares, the derivative markets or derivatives contract takes place through BSE, NSE, which are called exchange traded. If I talk of commodity derivatives, it takes place through MCX, NCDEX. These two are exchanges, are commodity exchanges, are also the government approved exchanges, and the commodity derivatives takes place through the exchanges. Apart from these exchange traded derivatives, there are also over the counter derivatives. Over the counter derivatives means it's a private contract between the two parties. We say OTC means over the counter, are private bilateral contract. Bilateral means between the two parties, and are not standardized. Such derivatives are specific to the need of the investor, like forward contract. Like see, if I am an importer, I import some product from European countries, right, or America, and I have to pay in terms of dollar. These days, the dollar is becoming more expensive and the value of the rupee is depreciating. So I know that my import will take place after 3 months. My import will take time, will be 3 months, and I have to make, after 3 months I will have to make payment in terms of the dollar. What I will do is that I'll buy dollars at a pre-specified price, because I am expecting that the dollar will appreciate and the value of rupee will depreciate. So I am buying dollar in advance at a pre-specified price, right, in advance, so that if the dollar appreciates further, then I'll not be a loser. So what I'll do is I will make a contract between with the other party to buy dollars at a particular price. This is called OTC contract, right? So depending on the amount of dollars I require, I require $2,450. So I'll be buying only $2,450 at a particular price, which will be determined between two of the parties, and the contract will take place. This is called over the counter derivatives. So broadly I would say these are the three derivative: exchange traded derivatives, over the counter derivatives, elementary derivatives and complex derivatives, and the commodity derivatives and financial derivatives. So these are the different types of derivatives which we'll be discussing in our lectures. Thank you very much.